This video is a walkthrough for a numerical example to deal with the different journal entries required for a partnership. Let's get right to it. Take a moment to pause the video, read through the example, and maybe even try it out yourself. Then come back to this video and take a look at the walkthrough of the solution. In this example, we are going to be recording journal entries for each transaction below. Starting in 16 on July 14th, Tulip and Rose agree to form a partnership and share profits and losses equally. They begin by combining the following assets. We can see that they contribute cash of $20,000 and $40,000 respectively, accounts receivable, and computers. We could record this transaction as follows. We would debit cash, debit accounts receivable, and debit the computers or equipment. We could calculate this as follows. The cash would be Tulip's contribution plus Rose's contribution. We would do the same for the accounts receivable. And once again, we would do the same for the computers. Now, we should be crediting each partner's capital account. Tulip, capital, for the total of Tulip's contributions, which was $20,000 plus $30,000 plus $5,000, which is $55,000. Next, we will credit Rose, capital, in the same way. $40,000 plus $25,000 plus $3,500 for a total of $68,500. We are not asked in this question to maintain T accounts, but I'll do so just to help us keep a visual of where each partner's capital balance is throughout the question. Moving on to the end of the year. The partnership reported net income for the year of $176,500. Recall from before that their initial agreement is to share the profits and losses equally. If that is the case, we can close income summary of $176,500 to each capital account. And credit Rose capital for $176,500, half of that amount, for a total of $88,250. If we were to update the partner capital balances, Tulip's balance would increase by $88,250, and Rose's capital balance would increase by the same amount to a total of $156,750. Moving on to the next year. Tulip and Rose agree to bring a new partner into the business, Thorn. The agreement is that Thorn will contribute $100,000 for a 30% stake in the partnership, and the partnership agreement specifies the allocation of profits and loss as follows. We can see that a fixed amount is the first thing to allocate in the amount of $30,000 to Tulip, $40,000 to Rose, and $50,000 to Thorn. Then we would take a percentage on the end of year capital balance before this income allocation process of 5% each. The remainder will be allocated by a ratio of 5-4-1. We'll return to this chart in a little while to allocate profits and losses to each partner. First, let's deal with the fact that Thorn is now part of the business. We'll have to do a calculation. The first thing we need to do is to calculate the total capital balances or the total equity in the partnership prior to admission of the new partner. We can do that by taking the amounts that we had been keeping track of above. Tulip had a capital balance of $143,250, and Rose had a capital balance of $156,750. That's a total of $300,000. Then we can add the new partner's contribution. The narrative specifies that Thorn is going to be contributing $100,000. This will be the total equity after the contribution. And 300 plus 100 is 400,000. The next step is to figure out, of that 400,000, how much is going to be allocated to the new partner, Thorn. Well, we know that the percentage to be allocated to Thorn was specified in the narrative. It says a 30% stake in the partnership. So 400,000 multiplied by 30% is 120,000. Okay. However, we know that Thorn's contribution was only 100,000, meaning that there is a bonus effectively being paid to Thorn. What this means, and what I mean by saying a bonus, is that Thorn contributed 100,000 but is getting capital allocated to their capital account of 120,000. That's basically 20,000 more than Thorn contributed. This could be done for a number of reasons. It's possible that the pre-existing partners really thought Thorn brought a lot to the business, and so they were willing to provide Thorn with this bonus as an incentive to bring Thorn into the business. Another possibility, beyond Thorn's skills and talents, could be that the pre-existing partners thought that Thorn was going to bring much needed cash into the business. And so for the sake of getting cash, they were willing to give up a little bit of capital. Let's take a look at how this transaction would be recorded. From the partnership's perspective, cash is brought into the business. The amount of cash was $100,000. The pre-existing partners, Tulip and Rose, both agreed prior to admitting this new partner to share profits and losses equally. This little bonus will be split equally amongst them. Their capital balances will go down. A reduction to a capital balance is a debit. So what we would do is we would take the $20,000 bonus, and 1/2 of that is essentially Tulip's responsibility. So of this 20,000, we can multiply that by 1/2. Same thing with Rose. Finally, we recognize the new partner and put them on the books. And they would be on the books for what they agreed to, $120,000. We can see that the total debits equal 120 and the total credits equal 120. This transaction balances. Now, even though we weren't asked to maintain T accounts, we are doing so to help visualize this transaction. Tulip's capital has been reduced by 10,000, and Rose's capital has been reduced by 10,000. Thorn's capital has just been put on the books for a total of 120,000. If we were to total 133,250 plus 146,750 plus 120, that would equal 400,000, which is equal to the total partner's equity after this contribution. Seems like everything is working out so far. Let's move on to the next transaction. The partnership reported net income of 400,000. In order to do this correctly, we need to go back and remind ourselves of what their partnership agreement looked like. There was a fixed amount paid to each partner, 30, 40, and 50,000. Then we take a percentage of 5% on their end of period capital before any allocations are done. And finally, the remainder is allocated via a ratio. So let's construct a little table to help us allocate this income. We can do so here. The amount of income to allocate. We know that the amount to allocate is 400,000. Let's make a column for each partner. Now we can go about allocating this income. The first item is the fixed ratio, the fixed amount, the fixed salary. It was as follows. I apologize for all the scrolling. 30,000 for Tulip, 40,000 for Rose, and 50,000 for Thorn. If we total that over here on the far right, we see that we have 280,000 left to allocate. Let's continue on. The next thing to do was a 5% interest on their end of capital balances prior to any allocation. So prior to doing this process, we know that Tulip's balance was 133,250. We can multiply that by 5%. Let me just try that again. Rose's ending balance was 146,750. And Thorn's ending balance was 120. We can sum these amounts across as well. And so now the amount left to allocate is 260,000. I'll put some space in here so it's a little easier to read. Finally, any remaining amount was to be allocated according to a ratio. Let's ensure that we know what that means. The ratio was to be done in what was known as a 5 to 4 to 1 ratio. Try that again. 5, 4, 1 ratio. What that means is of the amount remaining, Tulip will get 5/10. One way that I try to get people to think of this if they are not familiar with ratios is to say 5 plus 4 plus 1. That would equal 10. And so each partner is going to get their portion of this overall 10. So Tulip will get 5/10, or 5 over 10. Rose will get 4 over 10, and Thorn will get 1/10. So let's do this. 5 divided by 10 multiplied by the 260,000 that's remaining. That's 130,000. We can take 4/10 and multiply that by the 260 remaining. That's 104,000. And finally, we can take 1/10 and multiply that by the 260 that was remaining, and that's 26,000. If we total this up, it equals 260,000. So the amount remaining to allocate is 0. We've fully allocated the income of 400,000. Now we just need to finish this off so we know how much to put to each partner in the journal entry. Totaling everything up, we can see that Tulip's portion of this income of 400,000 is 166,663. Rose is $338, and Thorn is 82,000. Let's record the journal entry. A debit to income summary for $400,000. Then we'll credit the capital accounts. Tulip capital for $166,663. Rose capital for $151,338. And finally, Thorn capital for $82,000. Let's update our capital balances before we move on. Tulip capital is going to go up by the amount that was just allocated, and we'll do the same for each partner, bringing their capital balances up to date. And now we can move on to the next year. Let's move on to the next year. Tulip feels that Thorn is being, well, a thorn in the side. Tulip agrees to leave the partnership for $250,000. Rose and Thorn decide to keep their partnership agreement ratios and percentages as is while removing Tulip. They decide to split the bonus from Tulip's departure equally. So taking a look at Tulip's capital account, we can see what's in it, $299,913. To remove this, we would have to debit the account for that amount. We also know that the partnership is going to be paying out cash. The cash paid out is $250,000. There are a lot of reasons a partner may wish to accept less than their capital balance. One might be that the partner just needs the cash and is willing to accept less in order to get paid quicker. It would appear from this transaction that Rose and Thorn are getting a bit of a bonus. So their capital amounts are going to increase. Rose capital is going to be credited and Thorn capital. They've decided to split this bonus equally from reading the narrative. So let's do the math. We would take the $299,913 and subtract the $250,000 payout. The difference would be the bonus. We can multiply that by a half. And we know that Thorn would get the same amount. Now, if we add up the credits, we get $299,913, and the total debits are $299,913. To update the capital accounts, we would see the following as a result of this transaction. Tulip's account goes to 0, and Tulip is effectively removed from the books. Rose's capital balance, however, will increase, and so will Thorn. At the end of the year, the partnership reports $250,000 in net income. One way to go about this would be to take that table that we did earlier and reuse it. Of course, with some necessary modification. For example, Tulip is no longer part of the business, so Tulip can be removed. Let's try to do this now. Again, the partnership reported $250,000 in net income. So the income to allocate is $250,000. The partners had a fixed salary. It was $40,000 for Rose and $50,000 for Thorn. The amount remaining to allocate, $250 subtract $90, is $160,000. Then there was a 5% interest on their capital balance before this allocation process. So what number do we have for that? If we go to Rose, Rose had $323,044. Try that again. Thorn had $226,956. And we just allocated $27,500 in total, which leaves $132,500 left. We were told earlier that Rose and Thorn would keep everything the same, but just remove Tulip. If we remove Tulip, we get the following, a 4-to-1 ratio. So we can take a 4-to-1 ratio as being 4 plus 1 equals 5. And so Rose will get 4/5 of whatever's left over, and Thorn would get 1/5. Try that again. And here we can see there's nothing left to allocate. If we were to total each partner's column, we could see of the $250,000, Rose is getting $162,152, and the remainder goes to Thorn. The total amounts still equal $250. So now we can go back and record the entry, a debit to income summary, for $250,000, and we credit each partner's capital account. Let's update the T accounts once again to keep track. Rose's capital account goes up by $162,152, and Thorn increases by $87,848. Let's move on to the next year. We are shown the updated balance sheet accounts are as follows: cash of $750,000, non-cash assets of $125,000, liabilities of $75,000, and then the partners' capital balances, and we can see that the capital balances equal the ones that we just worked out from before. We are then told that Rose and Thorn decide to liquidate the partnership. They sell the non-cash assets for $100,000 and decide to share that loss on the sale equally. Let's record these transactions to liquidate the partnership. First, we can sell the non-cash assets. So we debit cash for the amount received, which is $100,000. Then we can look to record or derecognize the non-cash assets of $125,000. We can see here that there is going to be a loss on the sale of non-cash assets, in this case of $25,000. This gets back to some of the steps we've reviewed, where step 1 in liquidating a partnership is to sell the assets. The next step that we talked about was A, or allocate the gain or loss. In this case, we have a loss of $25,000 that needs to be allocated to each partner's capital account. We were told in the question that they will share this loss on the sale equally. So let's deal with that. We can debit Rose capital for 1/2 of this loss amount and do the same for Thorn capital, 1/2 of $25,000. We can credit the loss on sale of non-cash assets. This is just one way to do this. The next thing we have to do is pay the liabilities. They can be paid by simply debiting the liability account and crediting cash. The liabilities were for $75,000. So we can debit our liabilities for $75,000 and credit cash for $75,000. The final thing to do is to pay out the partners according to their capital balances, not their profit and loss agreement. And that is because what's left in the business is not necessarily profits, but it should only be cash, and their capital balances are their claims to the assets left in the business. Let's take a quick moment to update the balance sheet accounts to illustrate what I mean. Here are the accounts. I'm going to copy and paste them. And this is what they look like prior to this transaction. Okay. Now if we take the result of this transaction and update these accounts, let's see what happens. We had $750,000 in cash, and what took place? Well, cash was increased by $100,000 as the result of the sale, and then cash was decreased by $75,000 when they went to pay out their liabilities. So total cash after all of this is $775,000. The non-cash assets were removed. They were sold. So what would be left there is nothing. So on the asset side of the balance sheet, all we have is cash. The liabilities, well, they were just paid, weren't they? So our liabilities are equal to 0. And our capital accounts were reduced slightly as a result of the loss on the sale of the assets. And we can see our updated balances here. $472,696 for Rose, $302,304 for Thorn. The total of those two accounts is $775,000, which happens to equal cash. That relationship hopefully looks familiar. In other words, we are seeing our assets are equal to our liabilities, which in this case are 0, plus our equity. And since liabilities are 0, we really have assets are equal to equity. Equity is the owner's claim to the assets in the business. So that is why, in this final step, we are going to pay out this cash, the remaining cash of $775,000, not according to a partnership agreement, but according to the partner's claim to the assets in the business. Okay, so we will reduce their capital balances. So we can reduce their capital balances. Rose capital will be debited for $472,696, bringing that account to 0, and Thorn capital would be reduced by $302,304, bringing that to 0. We would pay out the remaining cash of $775,000, and cash will be brought to 0. The capital accounts will be brought to 0. There's nothing left on the books, and this partnership is liquidated. I hope you found that example helpful and maybe it furthered your understanding of the topic. So until next time, thanks for watching.